Welcome, ladies and gentlemen, to our regular 6-minute strategy summary. In this episode, I'm going to reflect first on the week's news. Lockdowns, I'm afraid, creeping back onto the agenda across Europe as infection rates exceed even those in the United States. We'll look at the UK latest monthly GDP for August, weaker, I'm afraid, than expected. And principally, we'll reflect on the IMF's World Economic Outlook, its flagship biannual publication, which looks at the messages from the lockdown and the steepest downturn the world economy has seen since the Great Depression. Let's start with the regular COVID-19 stringency data that we look at in these reports. The UK at 67.6, still I'm afraid among the highest and tightest lockdowns around the world, and that's even pre the measures announced this week by Prime Minister Johnson. In fact, most of those lines trending upwards, showing how difficult Western economies find it to hold those measures below 50% rating and still keep the pandemic under some sort of control. Those tighter lockdowns, I'm afraid, feeding into business sentiment. The composite PMI is beginning to roll over. Remember, a reading below 50 indicates contraction. So those sharp rebounds post the immediate crisis beginning to fade. You can see this in particular detail for the UK, which is unusual as one of the world economies that publishes monthly data. So this is for August. Now we had very strong June, plus 9.1%, very strong July, plus 6.4%, fading to 2.1% in August. So that V-shaped recovery we've been hoping for beginning to fade, I'm afraid. On the right, you can see the breakdown of the data. First on the top right, a 9.2% contraction in overall growth since the beginning of the crisis, by far the worst that the UK has seen even in wartime. For this month, the index of services slightly better at plus 2.4. That was eat out to help out and construction bouncing, but still signs of continuing fade. So let's look forward from the immediate news data to the future in the IMF's World Economic Outlook, their flagship biannual report, where they refer to a long, uneven and uncertain recovery. And we can see what they mean in the chart below. The dotted lines are the trajectory of GDP pre-crisis. The thick lines are the trajectory of GDP in their October outlook. Extraordinary for China, there's not too much of a difference. The economy will actually rebound and grow by 1.9% this year. That compares to the rest of the world, which is contracting by 4.4%. Particularly worrying is the gap between those two green lines, the emerging world ex-China pre-crisis and post-crisis. Some very sharp slowdowns, particularly in recent data from India. Also, I'm afraid the very weakest economy is suffering particularly. The IMF in their report projecting that 90 million people could fall below the $1.90 per day, that pathetically small number that is defined as extreme deprivation. So some real pain in the emerging world, particularly in a way that hurts the female workforce they reported, the informally employed, and those with lower educational qualifications. So a big global effort needed to deal with that. For the Western economies, it seems that we have two key problems. First of all, rebuilding networks after COVID is going to be hard. I've shown that in 3 illustrations on slide 5, a typical human network pre-COVID-19, then that break apart with social distancing, and reconnecting those business, personal and informal networks is going to really damage short-term economic and societal growth and development. The second effect is really the reduced productivity, which I'm afraid is going to be scarring for some time. The academics really identify 3 problems. A sharp near-term fall in investment, and this always hurts the productive capacity of world economies. Secondly, I'm afraid the number of new smaller firms are going to fail, and research shows that these younger firms tend to be more productive. Thirdly, what they call hysteresis. Laid off workers lose skill, become detached from the labour market and lower labour supply. This is quite a damaging long-term effect. So we really have 5 key worries which we're going to invest around. First, the shifting demographics, which were bad before the crisis, will continue. An ageing population, slower growth drivers, and of course high welfare spending. Secondly, while with many benefits, tameless technology, that winner takes all attitude of global IT companies today does threaten labour substitution, and while it's positive for industrial productivity, it's very disruptive. Thirdly, what we call modern economic policies, the zero interest rates, negative yields in many cases, QE, financial repression, Added to that, extremely large fiscal spending and debt monetization to fund this. Fourth, what we call a restless society, the levelling up agenda needed, populism, walled gardens, protectionism, and rebalancing of shareholder stakes as those who benefited from low interest rates begin to subsidise those who suffered from low incomes. And finally, of course, the environmental challenges. We'll be investing around all of these with our thematic approach. We'll stay global, stay thematic, and continue our focus on real, sustainable, and socially responsible assets. If we can succeed and follow the investment trends that mitigate these 5 challenges, then perhaps with interest rates zero or negative in many markets and bond yields sitting around the zero bound, there is a real opportunity still for capital appreciation and equity growth in the months and years ahead. Thank you.